I would tell people, and I tell all my clients this, like you have to change what you're doing. So say you're a doctor. I give lots of examples like as doctors. And they're like, I am so sick of paying taxes. And of course they are. They're paying $150,000 in taxes a year on their $500,000 wage. If you're a doctor and you're making a W-2 wage and you just keep doing that, there's very little you can do. Or if you don't make a pretty dramatic shift, there's not a lot you can deduct. So what I tell people, I'm like, you have to change something. You can stay as a doctor, but then start looking at alternatives. Like what types of investments could I get into that could create these deductions? And a lot, like probably more than half my recommendations, maybe more than half my clients, it ends up in real estate.
Hello, and welcome to the Infinite Financial Freedom Podcast, where we empower you with financial literacy and we guide you on your journey to financial freedom. I'm Josh Metal. I'm here today with Brent Bement, president of Bement and Company and host of the Wealth Game podcast, which is fantastic. You should subscribe. Brent is a successful entrepreneur. He's an investor. He's a certified public accountant. He serves clients in all 50 states. And he's here today to really teach us how to grow our wealth through investments and keep more of our wealth by reducing our taxes. He was referred to me by a very close friend of mine, an investor partner of mine, and I am beyond excited for this episode. So Brent, thanks for coming along, bud.
Very, very happy to be here. Yeah, thanks you guys so much for having me.
Well, let's jump in because you are similarly to me. You started acquiring real estates in Salt Lake City, Utah, real estate investments, I should say, prior to the 2008 market crash. So let's just kind of start out with like, how did you survive and what was that experience like for you as you were going through that time?
Yep, definitely a fun time. My wife and I had gotten married. So we did house hacking. I'm sure you guys have heard of house hacking. You've probably talked about it here.
Yep.
And it was not our plan to house hack this house. We were just like, we want a place to live. We were married 6 months. We were sick of paying rent. And I was in accounting school and I'm just ready to start putting my money into my own pocket instead of paying rent. And we found this condo in the Salt Lake Valley. I'm like, yes, we're going to buy this. This was like, I think it was June of 2008. And if you go back and look at the calendar of the values of real estate, it's kind of funny looking back at it now.
That's pretty much the top.
Yeah. So right at the top, in literally within 3 or 4 months. And this is like, if you've talked with accountants, like I was in accounting school, but not all accountants are that business savvy, investment savvy, and real estate. Like they're just completely different worlds. But I was dipping my toe into it at the time. And I remember seeing like the estimates of value. I don't know if there was even Zillow at the time, but whatever value we were coming up with, I'm like, this house we just bought, it was like $135,000 that we bought it for. I'm like, this house we just bought is worth 90. Our neighbors just sold theirs for 90. Like that stress, like the amount we saved, all of our savings, like at the time, it was just like all of our savings, like everything we had just saved. My wife had been saving since she was like in junior high. Like we just dropped, it was like a $15,000 down payment. I'm like, it's gone. So like there was that just gut feeling like we made a horrible mistake. We started to look at the alternatives. People were, foreclosing and doing the short sales and all that stuff. I'm like, this is it. We got to hang on to this. We are not selling at a loss. 10 years from now, and I'll probably say this more in the call today, like having that long-term perspective, I look back, like that decision of keeping that property completely changed our trajectory. We would be in a completely different world right now as far as our net worth and investment. It would be so dramatically different. So I'm so thankful we hung on and stuck with it. But what we ended up doing, we ended up having twins. Like 2 years later, we had to move out of the house. It was still valued, I think, probably maybe a little less than what we had paid for it. We had twins. We'd already outgrown it. And at that time, we did the house hack. We kept it. We were able to keep it, rent it, qualify for the mortgage using the rent income, and we got into our new house. And then it continued from there, and we house hacked that and just kept continuing to invest. But it was a very stressful time, I'm sure, for a lot of people that experienced that. But our timing was just perfectly bad.
Well, you learned a lot of lessons real fast. Do you still own that condo?
I do. Yep.
You do.
I
Wow.
part of me never wants to sell it.
Of
Like I just
course.
want to keep that. Like it's worth more than double now
Hmm.
what it was. And 2020, we were able to be creative and get some really cheap cash out of it and do all that fun stuff. But we've got it. It's great. We've got a great long-term tenant over the whatever 16, 18 years or whatever. We're only on our third tenant.
That's incredible.
Yeah.
Wow.
So some really good long-term tenants, thankfully.
Do you remember what you charged for rent right when you moved out? Like what was the first amount you rented it for?
Yeah, it was, I bet it was $800 or $900 a month.
And would you know what you rent it for now?
Yeah, now it's just over 1400.
Yeah, so it's almost doubled in
Yeah.
your rental income there.
Yep.
You know, what I think surprises me the most, so we have a very similar story. The first one of the very first, I don't know if it's the very first or the second, but one of the very first investment properties my mom and I bought together. We've been partners buying rental. We started buying rental properties in about 2000.
Okay.
And we went into the Great Recession. We had about 57 to 60, low 60s numbers of single family homes. And man, I'm telling you what, it was the scariest thing I've ever seen in my entire life. We had a condo similar to yours that we bought and had about the same thing. By the time we renovated the property and put it up, we were actually going to resell it. The property value had dropped about a third, really similar numbers to yours.
Yeah.
And I remember
Yeah.
people at the time, you probably remember this, people saying, oh, it'll take 2 decades for this appreciation to come back. Like if you lost 30% in value and it only appreciates 3% a year,
Yeah.
you're a decade out of breaking even. And people were walking away from their homes left and right. And similarly to you, I remember making that conscious decision. Okay, I'm either going to default on my word to all of these banks, or I'm going to hang on by the hair of my chinny chin chin and try to make this thing through. But on the other side, I'm going to have my credit. I'm going to be able to rebound when the market comes back a little bit and I'm making money again, and I can build from there. And to your point earlier, had we taken that easy road out, there's no way we could have built what we've built over that last 20 years. So
Yeah. The credit was a big part of my decision as well. Like I
big
don't want to
part.
ruin that for so many years. Yeah.
Yeah, right on. Well, I'm glad to hear you survived. I'm glad to hear you still have it. The one other thing I was going to say about that is, that condo that we bought, I think it was back right around 2001, 2000, something like that. The thing that surprised me the most about that, Brent, was that when we were upside down, we rented it. We were probably $65 a month positive cash flow. And I believe our rental rate at that time was $350 a month for a 2-bedroom condo in Sugar House. Today, that same condo rents out for $16.95. And
Yeah.
that's what I think people don't really see, because people don't think well in terms of decades. They think well in terms of hours, days, maybe weeks, but they don't think well in terms of decades. And when you think about, you can secure that piece of real estate with a debt on it, and the rent income on that property has gone up 5x, while my mortgage payment stayed the same the
Yep.
whole time.
Same the whole
Actually, we
time.
paid it off, but it would have stayed the same. So that's the magic in real estate, in my opinion.
It's easy to run math on a 1 year return on your investment, but
Yep.
it's hard. And I've got all sorts of tools and stuff where I run these through these calculations, and I admit it's hard and just about impossible to accurately predict your return, but you can like use general numbers and estimates and projections. You can come up with some comparisons and why it makes sense to hold it long term.
That's right. That's right. The second and third decade, it makes a lot of sense to own rental real estate. The first
Yeah.
decade sometimes can be a little slim.
Yeah. Yeah.
So you're like the renegade CPA, Brent. Most CPAs, as you said, they're accountants. They're number people. They're not risk takers.
Yeah.
And real estate investors, entrepreneurs, they're risk takers. So how did that journey come together with you specializing in tax strategies for real estate investors? And how did that mature in your journey?
Yeah. Yeah. Well, it started as a young age. I was not really an accountant at heart at a young age, but growing up, if you asked me what I wanted to do when I grew up, I wanted to become an accountant. So you might wonder, like, why would you say that? My dad was a CPA
Okay.
and he was an accountant. He ran his own firm. I loved seeing the flexibility he had as his own business owner. But just being a business owner, being an accountant, I honestly didn't even know what accountants did when I was young. And then going into college and high school and college, more I got into it, I'm like, yeah, it just makes sense. Like it's the fundamentals of a business. But at the same time, I was really like the other part of me was coming out as well. I'm like, I was really drawn to like marketing. I took all the marketing class. I took some college marketing classes in high school. And then when I was in my accounting course at the University of Utah, I got accepted into, I was still taking marketing classes. Like I was kind of two-faced, but in a good way. I'm like, okay, I'm drawn from what I can out of the marketing program, but I'm also, or accounting, but I'm also in marketing. I did not minor in marketing, but I was like 2 classes away from minoring in marketing. But I've just had that like mentality and personality of just wanting to just push back from the norm. Like, I don't know, all the different trends that come out in the world. And even when I was young and teenager, I'm like, okay, everyone's wearing this brand of clothes. I'm like, I want to wear like the opposite of that. I just want to wear the other brand of clothes that no one else is wearing. I just was kind of had that personality, but it really didn't start to like that was my personality, but it really didn't start to get into my like financial life and even the way I was as an accountant until my dad died. And he passed away in 2017. And I worked closely with him. Literally, our offices were next to each other, worked in the same firm. It was his firm at the time. And after he died, a lot of like digging into the financials. If anyone has had someone in your family die, you know, it's just kind of thrown upon you. You got to start sorting through financial stuff and just really digging into all this financial stuff. He was not a risk taker. He was very good with clients, but not a risk taker with his personal financials, just more of like a typical put money into a retirement plan. And I'm just looking at it. I'm like, he worked for so many years, 30, 40 years. He's got a little bit of a nest egg in his retirement plan, but no additional real estate, no rental real estate, no alternative investments. And we basically just use the debt or use the retirement plan to pay off debt. Like there just wasn't a lot, and we're not like we needed a lot, but it was just sad to see like debt and his finances and kind of what it did to him. Like, all right, I got to make a change. And so that was part of the trigger point in 2017. Like we had a couple rental properties at the time. I'm like, I've got to accelerate this. Like I really need to just dig into this. And I started to just do a ton of research. And I was already a CPA, knew a lot of like the underlying stuff of it, but it's so weird. Like until you are doing something yourself, like it wasn't until I started to do it myself when it just clicked, like so just in such a big way for me and my clients. And my clients started to see it and they're like, oh, what are you doing? And as soon as I could start saying, this is what I'm doing, it just opened up the firm, the growth of the firm, growth of our employees, and the way we worked with clients. It just completely changed. And I just went headfirst into real estate. And I already had like the personality of like being willing and open to taking on risks and working differently, but I just hadn't done it till that point. And then from that point on, we were acquiring multiple rental properties every year until last year, and we're going to continue on that. But there's all sorts of stuff. You've talked about this, I know you have, but like what drove me to real estate. So one was just wanting to do something different, grow a different type of like long-term plan and financial life than my dad. But then just being excited about doing something different and being willing to take on some risks and debt. And it's just really exciting. Like when you do the calculation, this is like nerdy accountant talk, but investors get into this too. And you have to get into this because when you see it, it really gets people excited. When you run the numbers on like a leveraged investment, and when you get like people throw the word leverage around all the time, right? And I'm sure you've run these numbers. When you run the number on like what a leveraged investment can do to your return on like your cash, like as an example, like if you have $100,000 and you go buy $100,000 property, you have $100,000 property, no debt. Like that's safe, right? You have $100,000 of cash, you put a down payment on $1 million property, 10% down would be nice, right? But you run the rates of return on that, whether it's IRR or like cap rates are, yeah, they're not going to change across the properties with the leverage, but your return on your specific investment, it's bonkers what the numbers do. It's like, oh, I get the safe return. Like when financial advisors look at real estate investors or real estate investments, they're like, you got a 5% cap rate there, buddy. That's not looking so good. We get 7 or 8% average on our money. And if you look at that $100,000 property, if you don't have any debt on it, it's like, yeah, that's for the cash flow. Yeah, your cash flow is better, not taking into account so many other things. But you run the numbers on the leveraged one, it's like, oh, how did you turn that into a 35% return on your money? It's like, that's how we did it. It was leverage. Man,
Great.
we could, yeah, our conversation, we could get into so many details and stuff, but yeah, I get pretty excited about this stuff.
Well, thanks for telling us the story about your dad, first of all.
Yeah,
And
yeah,
it sounds like you learned a lot of lessons there. I was thinking to myself, if you don't understand inflation and how to put your dollars, your investments in things that are inflation proof or hedged for inflation, I should say, real estate being amongst the best of them. And
yeah,
if you don't understand how to reduce, if not eliminate, in some instances, you can even be as aggressive and as fortunate enough to, and we'll get into some strategies here to, how to offset taxable income. But if you can't reduce your tax burden and you don't know how to hedge for inflation, it's really hard, no matter how hard you work, even how much money you make, it's really hard to end up wealthy. And there's a stat of US household wealth, and you're probably well aware of this, Brent, but 50% of Americans, 90% of Americans, 90% of the households in America only control 1/3 of the wealth, which means 10% of American households control 66% of the wealth in America. And the reason for that is that 10% at the top, they understand how to hedge for inflation and they understand how to reduce their tax liability. So that's really what I want to get into next with you. So let me ask you this,
yeah.
from your perspective, and you've got, you come from a line of CPAs and now you're an investor and of course you're in the business. What do you believe is the best investment strategies to help grow wealth and reduce taxes?
Yeah, I would say, because I meet with a lot of clients and they might even frame the question exactly like that. Like they're looking for the best option for them. And it does change for the specific person. But I would tell people, and I tell all my clients this, like you have to change what you're doing. It's like, wait, what's the definition of insanity? Like doing the same thing over and over, expecting a different result. Like you have to change what you're doing. And this, whether it's so say you're a doctor. I give lots of examples like as doctors.
Yep.
Say there's a doctor makes $500,000 a year, and they're like, I am so sick of paying taxes. And of course they are. They're paying $150,000 in taxes a year on their $500,000 wage. They got payroll tax, they got income tax, they got the federal and state income tax,
Property taxes.
yeah, property tax.
Yep.
Like, and if you're a doctor and you're making a W-2 wage and you just keep doing that, there's very little you can do. Or if you don't make a pretty dramatic shift, there's not a lot you can deduct. Like the basic, I call it like the basic, just standard tax deductions. You put a little money, you put some money into a 401k, you write off your home mortgage interest. It's like the personal deductions. Maybe you got medical costs. You probably can't, it's probably not going to help you anyways. Write off your property taxes and your state taxes. That's it. Maybe put money into an HSA, but there's not a lot of options. So what I tell people, I'm like, you have to change something. You can stay as a doctor, but then start looking at alternatives. Like what types of investments could I get into that could create these deductions? And a lot, like probably more than half my recommendations, maybe more than half my clients, it ends up in real estate. So then we go into like, okay, so I'll let the cat out of the bag. Real estate is my favorite. It's what I do, and most of the time it is what I recommend. But your facts and circumstances of how your tax returns not only look, but just like actually what is going on in your financial life, it has to be set up in a way to allow you to use the deductions from real estate. like there's certain scenarios where if that doctor just goes and drops $100,000 in a passive investment, someone else is doing all the work for him, he's probably not going to get that deduction. The real estate itself can be a tax efficient deduction. It can help offset like a hedge against inflation. It's a tax efficient investment, but it's not going to change his personal tax situation much. Could be a good investment, but maybe not going to drop his taxable income a bunch. But there's these strategies as people get more active. Like that doctor, I might say, go form an LLC. Go get active in real estate. Go buy your own piece of real estate. Or your own real estate. Go build your own property, or go have a short-term rental, or do it with a partner. Like the closer you get to the real estate, like the actual management of it, the more likely you can actually take those deductions, accelerated depreciation, cost segregations. We'll get into some of the stuff. The more likely you can offset your income. For business owners and like people that are solely in real estate, it's easy. It's much easier. But for that doctor, you've got to have more things that connect you directly to that real estate. You got to get more active. You got to participate more closely with it. But there's definitely ways to do it.
And most of our audience is physicians, dentists, other medical professionals, entrepreneurs, self-employed people, and then of course, investors. So you're speaking right to the heart of our audience. Appreciate you doing that. The residential housing market sure is hard to predict. Are prices about to crash, or are they going to continue going up? What about mortgage rates? Are mortgage rates ever going to come down? And how about demographics? Will Gen Z and the millennials push the housing market higher from here? These are just a few of the questions that we answer for you in the Fall 2024 Physician Home Buying Guide. If you're a physician or medical professional, check out our Fall Home Buying Guide, where we teach you how to escape the landmines and execute a flawless home purchase. If you'd like insights onto what's going on in the housing market this fall, check out the link in the description for the free download. Let's go a little deeper down this path. And let's talk about tax segregation studies. Maybe we could use the example of a dentist owning his own practice, owning his own buildings, or partnering. You know, I've seen some very successful doctors partner together, pool money together, buy apartment buildings, those types of things. So let's just get into a little bit of nuance without losing people. What are tax segregation studies? What are the qualifications? And how can that offset earned income?
Yeah, that's perfect. So when there's a doctor, in that first example I gave, the doctor was a W-2 employee. A doctor that's self-employed, so say you're a dentist, you've got employees, you've got likely an S corporation where you run your operations through the dental practice through. If you are open to owning real estate, and if you're listening to this, you probably are, if you're open to owning real estate for your practice, because like, remember the standard way to do it is you have a practice, you're paying rent to the landlord. And it's like you deduct the cash that goes out. But there is and I like this, but there is a disconnect, like tax deduction, like the amount of the tax deduction does not have to equal the amount of cash outflow that you've got. So when you run some of these numbers, there are quote unquote free tax deductions or tax deductions you can create without paying for them. There's a lot that goes into it, but you don't have to pay the cash to get the deduction. So as an example, let's use that $500,000 example, but let's just assume it's self-employment income for the dentist. If you were to go buy a building, and for easy math, I throw a lot of numbers around when I'm throwing stuff up, but let's say it's $1 million building. And I know that'd be a pretty cheap building for a dental practice, but
good round number.
Math. Yeah, round number, $1 million building. If we were to do a cost segregation, so I'm going to explain where the cost segregation comes in without boring you with all the details, but I'll give you enough details where it'll make you dangerous. It'll make you be able to make pretty decisive decisions on the amount of deductions you can take from this. In a typical building purchase on that $1 million building, part of it is going to be allocated to building, like just
the value,
building, and part of it is going to be to the land. So as a rough example, $800,000 goes to building, $200,000 goes to land. The default depreciation deduction you get on that, it's going to take 39 years to write off that $800,000 portion of the building. So if you do the quick math on that, so 800,000, whatever 800,000 is, divided by 39, that's your annual tax deduction. The alternative is the accelerated depreciation that we all get excited about. It's the bonus depreciation and it's the cost segregations. So what we do in a cost segregation, we take that 800,000 and we go, well, what's in this 800,000? And just think of like a building from top down. You go, well, it's got a roof, it's got walls, it's got a foundation. Those three things, those are going to, you still write those off over 39 years typically. But then think of everything else you've got. You've got landscaping, dental offices. It's got to look good on the outside too. You've got landscaping and flooring and tiles and fixtures and paint and
HVAC,
trim. Think
AC
of, you
units.
got HVAC.
Oh,
Think of
so expensive.
everything that you could go into a building, that you could just take out of a building without destroying the building. I call this the other category. It's personal property for the cost segregation term, but this other category, that's what we get excited about. Because this other category, a lot of times, is like 50% of that 800,000. So in this example, 400,000, that is eligible for bonus depreciation. That 400,000 is under 100% bonus depreciation. The days like 2022, we could write off 100% of that. That, as the dental practice owner, that 400,000 could go and offset your $500,000 of income. So instead of you paying tax on $500,000 of income, you're paying tax on 100,000. It's a massive shift. And then if you're like, well, I can't buy $1 million building. What if I bought a $4 million building? Well, if you bought a $4 million building, we're just going to have a lot more depreciation to play with. And if we don't use it in that year, we can just carry it forward to future years. And it's
And
really
remember,
cool. Yeah, we can
I
decide
was
when to
just going to
take it.
say, like, that can sound out of reach to somebody who hasn't thought through that. But remember, if you're a dentist, a medical professional, an entrepreneur, and you are going to put your business inside of that building, you can do an SBA loan. So you could buy $1 million building and only put 10% down. You could only be 100,000 into that building. You could buy a 4 million building and do a build out and do all your medical equipment and all of your dental equipment, finance all of it in, and only put 10% down. And so really it can get so advantageous that you're making a decision, am I going to pay taxes this year? Or am I going to use that money I would have paid taxes to put a down payment on the building so that I can take the depreciation, the bonus depreciation, and write off that income so that I can retain that money rather than paying it out to the IRS?
That's the perfect way to think of it. It's like doing a lot of these tax projections, like this time of year, we go, okay, there's $150,000 tax bill looming. And even if you prepaid some of that, you can get it back. You go, okay, it's $150,000 of taxes. When this tax year ends, this is a comment I make to a lot of people. It's like that $150,000, like it creates some urgency in clients. It's like when this tax year ends, that is gone. That is gone forever. It just got sent to Ukraine or whatever the government's doing with it. That money's gone forever. Because people will say, well, I wouldn't say go and rush into investment that's not going to make sense, but I was like, well, I'm just going to do it next year. I'll still get the deduction, right? It's like, yes, you still will get the deduction next year, but that 150,000 this year will be gone by that point. And if you, as business owners, we think a lot of our decisions are based on cash flow. Not all of them should be, but it's like you need cash flow to survive. You need cash flow to pay your employees. When you think of the cash flow like that, like, does it go to the government or does it go into this building as a down payment? It really is like a savings account for yourself, your future self. Because at some point in the future, you'll get that cash out. When the building's sold, you do a cash out refinance, that money's coming back to you. So watching like and I call my podcast is the Wealth Game podcast. I don't manage people's wealth. I'm not a financial advisor, but just watching the wealth, like net worth, like when I think of wealth, like think of like net worth, like your net assets. Like when you start tracking that instead of like a specific rate of return or a cash flow, watch your net worth like over the years. And if you plan long-term for the net worth growth, it's amazing what can happen.
Really well said. Really well said. Do you want to touch on at all the qualifications to qualify for taking that bonus depreciation?
Yeah, it's really important to mention that because there's people out there, and this is a little bit of a misconception with real estate where people, a lot of times it's people raising funds for real estate. Will say, yeah, give us your 100 grand. We'll give you an $80,000 deduction. They're not the ones doing the tax returns. They're not the CPAs on the ground, like checking the boxes and helping the client stay safe in the eyes of the IRS. As a business owner, like a good rule of thumb, like as a business owner, if you're using that building in your business, you're going to be safe to use that deduction to offset your business income. If you went and bought say you went and bought an apartment building with partners, it's going to change a little because it's not your business. It's not an active business that you're running. Then it becomes, you might be able to deduct that loss. You might be able to deduct the loss in that year. There's a few more hoops you gotta jump through. It's the passive activity loss limitations, which is kind of a bad word, but we have to go through it. So when I think of passive loss limitations, we want real estate to be passive, right? We want the passive returns. So what we do a lot of times in planning with clients is like, what types of income can you offset with those passive losses? So maybe same facts and scenario, but it's not your dental office. It's a $1 million apartment building. There could be a $400,000 deduction there. $400,000 deduction comes to you on your personal tax return. It's like, okay, can we use this? And if you have other passive income, like if you're an investor in a business and you're a passive owner, we could use it to offset that. If you have other rentals, other types of rental income, we can offset that. Couple like worst case scenarios are like when you sell the property, you can always use it when you sell it. Like it's not a lost deduction. It just gets held up. It's a suspended loss. So at some point you can use that loss, but sometimes it's not in that exact year.
And sometimes this can feel complicated. Like, man, do I really want to go through all this trouble to organize my life for tax efficiency? And I just offer this. We were talking before we started hit recording, Brent. One of the lessons that I learned as a 19-year-old listening to Rich Dad Poor Dad by Robert Kiyosaki, who I got a chance to meet a couple of weeks ago, which was really cool, by the way.
Oh, that is cool.
It was really fun. He has this picture in his book that's called the cash flow quadrants. And he said, look, there's really only 4 quadrants of businesses or employment income structures. He says, I'll simplify it. There's employees in the top left. Below that, there's small business owners. On the right-hand side, you have big business owners that have different deductions than small business owners in different ways to shelter income. And then in the bottom right, which is like the sweet spot, is the investor. And ultimately, all the wealthy people I know hang out on the right side of the quadrant. They're either big business owners or they're investors, and they've figured out how to organize their lives so that they are doing what the tax code is incentivizing us to do as entrepreneurs, business owners, and investors. And if you organize your life that way, you're rewarded with these huge, unbelievable, life-changing type deduction capabilities where literally you can make the decision, am I going to write the check to the IRS, or am I going to buy the investment or do the thing that the IRS is encouraging us to do so that I don't have to pay taxes? It is that big of a gain. So if you're someone who's feeling like, I've been running on this hamster wheel really, really fast, and I'm not really getting very far, then you should consult with somebody like Brent, who can help you kind of create some of these strategies and make it a little bit easier for you.
Yeah, when you view the tax code as like a roadmap of what you can do,
yes,
it completely, and just having that mindset of like, oh, I'm stuck with paying taxes. And actually, like, taxes are not optional. When you're a W-2 employee, under that set of facts and circumstances, you have to pay taxes. You have to pay payroll taxes. Like, you got a W-2 with 500,000 on it, it's not optional. You have to pay it. But as you shift through those different quadrants, you're moving to the right side, you become a business owner, and you start structuring. Like, we do a lot of entity structuring. Like, so I'm sorry if you've ever seen me pull out my whiteboard and I start getting these entities involved, and S corporations for the operating business, partnerships as your holding company with you and a spouse. But as you start creating these structures, not just for complexity's sake, but like actually creating, having bank accounts, like operating it like one of these bigger businesses, the
Yep.
tax code, the tax code doesn't discriminate. Like if you are structured like these other companies and you're doing like these big corporations, big investment companies, and you're doing the same things they're doing, like of
You get the
course
same
they're writing
benefits.
off, they've got income and expenses and they're writing off their travel related to that activity. Like of course it's a deduction. It's literally in the tax code. It's not even a loophole. It's just a more complex set of the tax code that a lot of people just don't even want to dig into. But you
Yeah,
structure your life, you make those changes, add a little more complexity where it becomes valid, and like not just being a W-2 employee, but being open to making some of these changes, it can drastically change your long-term wealth growth.
really well said. So I learned something new this year, Brent, and I'm pretty
Yeah.
stoked about it. And we can be nerds together. The 263A deduction. And I was really excited to learn this. And I thought, man, I really want to bring this to our medical professional community because many of them may be considering or perhaps have bought their own office, done a build out, bought all the equipment in the office. You know, some of those office buildings have $1 million of equipment in them. And I learned that there is this small business 263A deduction, which is a layer deeper and offers additional deductions on top of the cost segregation study. So let me tell you my story really quick and then explain it and make it simple for everybody to understand. In my family, my wife qualifies as a real estate professional. She works 40 hours a week in our real estate business, all the accounting, pays the bills, the whole deal. And we bought an apartment building in 2020, I think it was. We started essentially from the shell in, completely remodeled the building. So we paid $1.5 million for the shell. We put about $3 million in renovation into it. And then as soon as we started renting out the property, we did a tax segregation study. I can't remember exactly, but we took about $1 million deduction, which means there was $1 million of earned income that was offset by that tax segregation study, bonus depreciation. We were able to pull that forward and offset that income. And by the way, if you didn't make $1 million that year, no problem. You can roll that deduction forward until you exhaust the future benefits. In 2024, earlier this year, the same firm that did my tax segregation study called up and said, "Hey, do you know what a 263A expense is?" I said, "No, I've never heard of it." And they said, "Well, we want to go back to your building that we already did the tax segregation on. We want to do a 263A and see if there's additional savings that can be brought out. So check this out." And then I'm going to shut up and let you talk, Brent. But this is just so cool. Like, I'm such a visual person. I think people will enjoy this. So this is the actual 263A expense analysis. It comes in a 14-page document and analysis. And basically, just like Brent described, there's like all these different types of property based on their values and how many years of
Yeah, look under the life. That life is how many years it typically takes to write off.
There you go. So
But yeah,
5-year assets, 7-year
yeah.
assets, 27.5-year assets. And I'll kind of just get to the punchline here. The 263 expense came out at 693,000. And then I think, Brent, you tell me if I'm wrong, the 481A adjustment is the actual amount of offset of income that I can use.
That's right.
This number transfers to my tax return for this entity, and it spun off an additional $507,390 in tax deductions above the $1 million in bonus depreciation that we took back in 2020. So explain this voodoo magic to us, Brent.
Yeah, this one specifically. So like you look at the top line, all those 5-year assets. So I can see there that I can see where, oh yeah, if you look at like the 848,843, that's the tax basis. And then you look at where it says previous year accumulated depreciation, same number, 2 lines over. Yeah, right there, 848, 843. Like they wrote it off. Like that is proof that was written off through a cost segregation. The 5-year assets and the 7-year assets, that like the cost segregation. There's also 15-year assets. The cost segregation gets you those deductions.
So that this number matched this number, which tells you this was already depreciated.
Yep. And so really like you got the benefit of those assets already. And that's why your 263A expense is higher than the actual adjustment you got. And you haven't have all the details, but where it really gets interesting is the 27.5 year property. So because the 263A is like, well, like with a lot of tax code, it starts with the restriction. It starts with like the rule. In 263A starts off and it says, hey, if you buy a rental property or you buy something to sell with your business, you can't write it off. It actually starts that way. It says you can't write it off in that year. You got to put it to your depreciation schedule. You need to put it into your inventory. You can't sell it until, or you can't deduct it until it's sold, or it's going to take you forever to write it off. Right. And then you dig down a little deeper in the tax code, and there's the 263A exceptions. It's like 263AI, I think. And that's when it gets into like, if you're building your property, what you did, and you're putting these improvements, you're placing this property in service during that period, it is like magic. Because if you have less than $29 million of revenue, and I think that's the 2024 number, you have to be a small business, but small business is pretty big.
That's pretty big business.
The threshold really is 29
I barely
million.
made it.
Yeah. So if you're under 29 million of top line revenue, and this is for your investment company that's filing the tax return, then you qualify for this. And what you qualify for is, instead of, you see the 27.5 life right there.
Yep.
Instead of writing off those assets over the full 27.5 years, the 263A study, we can go in and identify like specific parts of it that can be accelerated, just not even accelerated, not even depreciated. It's a straight up deduction.
Straight deduction. That's right.
Yeah. It doesn't even go to your asset schedule. You don't have to have a life of it. It goes straight as a deduction. It's not a loophole. I don't call things loophole in the tax code. They wrote the tax code like this, but this is a buried part of the tax code. One of the requirements is that you need to be holding the property. This, construction companies, construction guys that are selling the property, they might not be as excited, because you have to be holding the property to rent it. You have to be building it so you can hold it as a rental. There could be some strategies. Like I have some construction clients that some of the properties they build to keep, some of them they build to sell. It can start changing some of their strategies. But like, if you were building, let's go back to the $1 million example. If you're building that $1 million building, like there are some exceptions here and there, but remember the $800,000 that was not land identified? Like under this, you can write off $800,000.
Yeah. So instead of on the tax segregation study, maybe you get 400,000. You're basically saying it's pretty much, you're going to be able to take a full write-off against your active income for that amount. It's incredible.
So the difference is, you've got to be building it and keeping it to rent as compared to just buying a building that's already built and renting it. But just make sure you're thinking of those differently.
And so I did this on an apartment building. Obviously, I don't live in the apartment building. My business is in an apartment building, but just for clarification purposes, if there's a doctor, a dentist, I should say a physician, a dentist, a medical professional, an entrepreneur, if they're going to put their business inside of that building, that doesn't prevent them from doing the 263A, right? They can still do that if they, okay.
We would likely structure it where they build the building and they're going to be renting it back to the S Corp.
Separate entity
have a holding company partnership. They're renting it, but it's the deduction would still offset that S Corp or their practice.
So I have said for years, and people kind of laugh when I say this, but I say, look, you can either invest in real estate or pay taxes, but you don't have to do both. The government is telling you they want you to go build stuff. Entrepreneurs, business owners, people that are willing to take a risk, go improve a neighborhood or a dilapidated building or build something from scratch, contribute to the US economy and GDP, and you will be rewarded handsomely with these abilities to take these deductions. But I think it's so insightful to actually see a case study and actually see the offsetting impact on escaping those taxes. So this was really powerful. What else should we know about these, or maybe we talked about tax segregation study. We talked about 263A. What else is like a magic pill for helping us be streamlining tax?
Well, I want to jump into real quick, like what you had said about your wife being a real estate professional. And
Sure, please.
you've probably talked about that here, but if people listening, it's like, yeah, my wife's not a real estate professional. Like I just want people to know about the different loopholes or the different ways that you can use these massive deductions, the accelerated deductions, the 263A, to offset your other income. Having your spouse as a real estate professional is definitely one of them. I was meeting with a couple last night and showing them the tax savings if one of them were to quit and become a real estate professional, and they go, that's more than they make.
Take home. Yep.
It was like
We had a
95
dual.
grand. They go, that's 95 grand. I make 90 or whatever. I'm going to quit my job tomorrow. Like they were serious about it.
We had a dual physician family who did the same thing. They looked at their dual income and they said, well, one of us could never be a real estate professional. And then they looked at the after tax income that one of the two were making, and then the tax deductions if they went full force. And they're like, it's almost a wash. And I don't have to, I can actually hang out with my kids and I can, run our family business. So please continue. But I have seen that in practice.
It's amazing. We've seen multiple people do it. We have a few different doctor groups in Texas, and they're like spreading the word. My spouse quit my job, or I quit my job, and it's like spreading, and they're reaching out and they want to do the same thing. But that is one of the loopholes or the ways around it. You've probably heard in the last few years, like short-term rental properties got really popular. When you manage your own short-term rental property, that activity is not passive. So we don't have those same limitations. So that's one of those, like, people are like, you know what? I want a vacation home here in Utah. We got Southern Utah. A lot of people have vacation homes in Southern Utah. In St. George, you go buy $1 million vacation home. You could do the same thing on that. Just keep it as a Airbnb or a VRBO, rent it out, run it like a business, and you can get that $400,000 deduction. And then becoming an investor, not just in real estate, but in real estate, like as it starts kicking off profit, you're going to have income that you want to offset, but also becoming an investor in businesses. There's either like, or oil and gas investments. We've had clients invest in like ATM businesses. That's like passive cash flow, but it's just income that's coming back to them. There's ways and different investments where you can create this passive income, and the real estate can offset that. So I would just think of like real estate losses. You either need to like fall under one of these exemptions, like short-term rental, have a spouse that's a real estate professional, or you are the real estate professional and active in it, or you need other passive income to offset.
Yes. Great.
But it's just amazing. Some of the opportunities.
Super valuable. I want to show you one more thing. This is a thought progression I've kind of come up with over the last couple of years. And I just want your feedback, because you're an investor. You've seen thousands of tax returns, presumably, second generation in the CPA field. And I just want your thoughts as an investor and as a tax expert. So one of the things I've been thinking a lot about is that real estate, and you're seeing that screen that says real estate is a multidimensional asset class.
Yep. I've got it.
So for many years, my mom and I and my wife, we partnered, and we were just focused on long-term strategies. So we owned apartment buildings, medical office buildings, retail buildings. We haven't owned storage and industrial, but it's an area that we're interested in. These are just examples of long-term strategies. And what I realized was this is really where the generational wealth occurs. These are usually larger buildings, so they spin off large tax segregation, bonus depreciation, write-offs. But the problem is that when you have a situation like we've had since 2022, where your prices of properties are elevated and mortgage rates are elevated at the same time, I'll stay away from cap rates and complicated lingo. It makes it really hard to cash flow. So we've probably analyzed 100 deals, Brent, over the last 2 years, and we haven't been able to contract one at a price that works for us based on where interest rates were. So we're essentially on the sideline. So I started thinking to myself, like, okay, how could these different investment strategies work together? So a short-term investment strategy is a strategy where you hold an investment, well, I call it 0 to 12 months. A medium-term investment strategy is something that I look at from 1 year to 10 years. And a long-term strategy is something that I'm going to hold. Hopefully my kids will inherit and they're smart enough to let their kids inherit, right? These are the life multi-generational type assets. And here's what I've started to realize, that when this isn't working because interest rates are elevated and prices are elevated, and you can't make anything cash flow, instead of just trying to play a one-dimensional real estate game, I'm going to focus over here. I'm going to focus on earned income in mortgage originations. We do private money lending. We do some flips. This is cash purchase program. It's just really like another private money lending type operation. And then we're going to take the money that we earn here. Now, what's wrong with short-term strategies? Highest tax rate. Like, you're paying the most amount of tax on this sort of income. So we're going to take this money and we're going to move it into medium-term strategies. Residential properties, maybe we buy something subject to its existing 3% mortgage rate, that so we can kind of sidestep the high interest rate environment. Small commercial properties, business investments, but really this is a holding structure. I call these piggy banks. These are my piggy banks that I'm planting seeds in. And I'm waiting for the next market opportunity where I can go out and buy a $10 million medical office building or a $20 million retail building. But I can't get into these big investments which have the maximum tax efficiency and also have the lowest friction as an owner once you've got them up and running.
Yeah.
But I'm moving my money that I'm earning in earned income out of cash, because since 1913, when the Federal Reserve was created, the US dollar has lost 99% of its buying power. So I got to get out of dollars, and I want to get into these medium strategies. I call these my little piggy banks. And then eventually I'm going to slaughter the piggy banks and I'm going to buy another long-term strategy. But even with these, I can do depreciation and help offset some of this short-term strategies or income from the short-term strategies. So let me just shut up for a second. What do you think about this? What am I missing? And what would you add to this?
I like it. Yeah, I'm liking what I'm seeing so far, because yeah, a lot of people, like, they want to jump right into, like, on the right side, you had apartment buildings.
Mm-hmm.
I just want to own an apartment building, but it's $4 million and I need $1 million cash right now. And it only cash flows this and it doesn't even cover the debt. It's like, it just doesn't make sense.
Yep.
But when you look at like the long-term ownership of it and you go, "No, but if you can leverage it right, the long-term growth and the amount of time involved and those big numbers, like your net worth and growth, like that's where you want to be." And I'm the same. I want all of it there. And I've been lucky or thankful, or maybe I've just been opportunistic and in the right place at the right time, but I've been able to get into a couple of these larger investments. And so, like, even if I was in the short term or medium term, I'd recommend to people, like, keep your eye out. Like what you're doing, you guys have analyzed 100 deals. There could be that 101st deal where it's a seller carry note, and they're like,
Yep.
"Yeah, we'll carry this at a 3% rate. You only have to give us 10% down." Like, and maybe an interest only payments for 5 years. Like, there's some of those unique strategies and opportunities that, like, you could jump into that type of stuff. But when people are starting, and whether it's someone with no cash and no assets, like, someone could start with flips, or they could start in some of these things, because a lot of, like, and those maybe not always the case with the four that you had listed, but I see like short-term things as more of like time intensive and less
Yes.
capital intensive.
Yes.
So as you get into those longer term strategies, it's like, okay, there's less time but more capital as my net worth grows,
100%.
and we're leveraging our own money to preserve time, to spend time with our family and friends and doing what we love to do. But I did like your comment about the tax efficiency of those ones on the lower end. Sometimes those are not, I won't say lower end, the short term end.
Uh-huh.
When you're actively involved, if you're flipping properties, if you're earning an interest rate on money that you're lending out to people, that's taxed at the highest tax rates. So if you're a doctor and you're making 500,000 and you go, "Oh, great, I made $100,000 doing flips." It's like, well, that $100,000 of profit, like 35% of that is gone to taxes.
Right.
But it's real estate income, and so you can kind of time that. So I really like doing more than one of these. So say you make 100,000 on a flip mid-year, when you're planning for taxes, I'd say, okay, really try to get into a real estate, like, even if it's a small residential rental, if we can create 100,000 of losses, we can offset your real estate income with that real estate loss.
There you go.
Like that's when you can start getting creative, and you're operating not on the left side of the cash flow quadrant. You're starting to operate as a business. And
You
it's,
summarized that
yeah,
perfectly. Thank you for that.
yeah, you're welcome.
Brent, I wish we had another hour,
Yeah, we
but this
could
has
keep
been
going for sure.
extraordinarily valuable for me. So I'm sure it's been extraordinarily valuable for our listeners. Um, Give us your podcast again. And also, where can people find you if they want to, if they're curious about creating a more tax efficient lifestyle and business? How do they find you?
Yeah, definitely. So the podcast is the Wealth Game Podcast. And if you go and search any podcast platform, just search Wealth Game, you'll see it pop up. It's like a golden rook with a black background. Or the website, if you go to wealthgame.io, I just started record. I've got all the podcasts there as well, but I started to record a lot of videos, some about what we've talked about today, a lot about real estate, about entity structuring. You'll see the whiteboard videos I've done there. I have something called the Wealth Game Basics. I think it's got 8 or 9 hours of just free videos I've recorded, and I just want people to see. And I give people some like real estate analyzer tools, net worth
Great.
tracking tools, and that's the Wealth Game Basics, all through wealthgame.io. And then if you think from like you really need, like, you get the education, you get the strategy, like when people are doing all this stuff, like you really do need a team of compliance experts, like a CPA firm, which is where I spend even more of my time. But Bement and Company is the CPA firm. And that's where we do most of the compliance. Well, all the compliance side of things related to entity structurings and partnerships and rental properties and people that are retired. But so we got the compliance side, it's bementcompany.com, and then the education and strategies at wealthgame.io.
Right on. Well, you're putting out some great work. Appreciate you being here with our audience today. And I hope people will reach out to you to think about how to get a little bit more tax efficient and how they can, hey, you've got 2 more months this year
Yeah.
to try to figure out a solution for your taxes. You still have time. Reach out to Brent. Brent, thanks so much. Appreciate you. Love to have you back in the future, my friend.
Yep. Thank you so much. Thanks, Josh. See you guys.